Welcome into this edition of the Organized Investor Show, brought to you by the one and only, the greatest of all time, Tennessee Wealth Management. It's me, Erik Ainge, former UT and Jets QB, host of the Erik Ainge Show, 9 to noon on 99.1 The Sports Animal. Guys, today's show is built around what might be the single most expensive sentence in retirement. Listen carefully. Quote, I don't want to sell that stock. I'd have to pay taxes on it. Oh, gosh. That one sentence has cost American retirees more money than almost any single investing mistake I can think of. We're calling today's show the most expensive sentence in retirement. The umbrella idea is simple. When you let tax fear drive your portfolio, you're not being smart, you're being controlled. Here's the roadmap. Segment 1, call Run the Math, Not the Feeling. Because that's the choice every retiree faces every day on every position that they own. You either let a vague tax feeling tell you what to do, what most advisors do, or you run real numbers on a real portfolio. Segment 2, Jerry walks you through a real client trade, actual numbers, actual tax bill, actual outcome. In segment 3, we put you in the driver's seat. December mutual fund distributions, the Roth conversion window, and decisions you can act on this week. All right, but segment 1 is the foundation. One idea you have to accept before any of the rest of it even matters. And a lot of advisors will tell you taxes will be ugly. That ugly is a feeling. It is not a number. All right, on the show with me, as always, Megan Hubbard. Megan is Jerry's daughter. She used to be a first grade teacher at CAK. She has a master's degree in curriculum and instruction, and she has somehow figured out how to explain the hard stuff like compound interest the way she used to explain phonics to 6-year-olds, which is exactly what most adults need, myself included. Jerry Goodman, Megan's dad, certified financial planner, 43 years in the business, and he manages every client account at Tennessee Wealth Management with his son-in-law, Jared. And of course, my beautiful wife, Susan Ainge, the newest member of the team, asking the questions a normal listener would ask and watching the rest of us scramble for the answers. Megan, let's do this. Let's take that sentence apart for the listener. Quote, I don't want to sell. I'd have to pay taxes. What are they really saying?
Erik, that sentence does two things at once, really, and only one of them is honest. The honest part, taxes are real. I think we all know that. If you sell something at a gain that is not in a retirement account, you owe money. The dishonest part is everything after the comma, because you don't really know how much tax it will be, okay? So what that sentence actually means is, I don't want to do the math, which, I mean, I will say I am not a math person, so I can feel for those people that don't want to do the math. Or you could also be thinking, my advisor doesn't want to do the math for me, which may also be true. Ugly is the word people reach for when they don't have a number.
And here's the truth. We've watched this for 43 years. Most advisors here are going to say something like, taxes would be ugly. You know, they're not protecting the client. They're protecting themselves. So running a tax swap, in other words, finding a better replacement, walking through the math, explaining the actual year-end tax bill, that could be a 2 or 3 hour conversation. You know, saying that taxes would be ugly, that's a 30-second phone call. So guess what most advisors are going to go with?
Okay, let me play the listener for a second. When I hear all of this, my first reaction is, but taxes are real. If I sell something and I owe the IRS $30,000, that money leaves my account. So talk me through why this isn't just kicking the IRS down the road, because that's the moment most listeners check out. They hear, pay tax now. They think that's painful, and the conversation dies.
Susan, that question is actually the whole show in just 60 seconds. There are only 3 places where capital gains actually disappear. Capital gains taxes, that is. 1, you die owning the stock, and your heirs get a stepped up so that the gain gets erased. 2, it's maybe inside of an IRA or a 401k where the capital gains don't apply. Now, they may eventually be a subject to ordinary income tax, but not capital gains taxes. 3, you can donate the assets to like a charity. That way, there is no tax, at least for your standpoint. So for every other taxable account, and there's a profit involved in it, there's tax that's going to be due. Either you pay it on the way into something better, or you pay it later on something mediocre that you're going to have to sell anyway.
So people think they're choosing between paying taxes and not paying taxes. And that's not actually the choice.
Susan, exactly. They're choosing between paying taxes for nothing and paying taxes to upgrade their portfolio. These are 2 completely different decisions. They just look identical on the outside if you don't run the math.
Jerry, this is where I want to make it concrete for the listener, because so far it's still philosophy. What does the math actually look like? Walk us through with simple numbers so I can understand it, that we can do in our head.
So you ask, here we go. The math hinges on something called consensus price target. What does that mean? Most listeners have never heard the phrase, so let's explain it. Every major stock out there has a group of Wall Street analysts that will follow them. They're full-time analysts, people at, say, Morgan Stanley, J.P. Morgan, Bank of America, Merrill Lynch, places like that. And they all publish for these companies a 12-month price target, what they think that stock is going to be worth. Now, if you average all of those targets together, you get what's called a consensus price target. Now, it's not a guarantee, but it's the collective educated guess of all the pros on Wall Street who do this all day, every day, and you can put it all together on a brokerage screen in 10 seconds, and it's what those analysts think, on average, the stock is worth.
So, Dad, the listener just heard you say, in quotes here, I'm putting in air quotes, not a guarantee?
Yeah, I was like, oh.
It would be nice if it was. It would be a whole lot easier, wouldn't it?
So why should they pay attention to it?
Well, the key word in that is it's potential, okay? It's the potential that you have to compare across different stocks. Now, think about this. If one stock has an 8% potential upside and the other one has, or another one has, let's say, 50% upside potential, you're not choosing between certainty and uncertainty. You're choosing between two uncertainties. One of them is just much bigger than the other one. That's the comparison that a tax-averse investor refuses to make, okay? Let me put it in real numbers. Picture a $100 position in an old, slow, dividend-paying stock, okay? Could be any number of things, but you bought it years ago at $40 a share, and now let's say it's worth $100, which is great. That means you're sitting on a gain of $60,000 of long-term gain. Let's say its consensus price target is 108. So it's trading at 100. They think it's worth 108. So that's an 8% mathematical potential upside. Now, left alone, that $100,000 has potential, according to that assumption, to grow roughly to $108,000 over the next year. Now, picture a completely different stock that maybe our team likes. Maybe it's beaten down, from a recent sell-off, whatever. And let's say that stock is also trading at 100, but the consensus price target is 150.
Wait, would that be a 50%?
It would be. It would be, Mr. Mathematician. So to make the swap, you're basically going to have to take, though, a long-term capital gain of $60,000. And let's say at a 20% tax rate, that's $12,000 in tax. So that leaves you $88,000 to redeploy.
And I'm doing the math right along with the listener. $100,000 staying put at 8% upside grows to $108,000. 88 redeployed at 50% upside grows to $132,000. Even after writing the IRS a $12,000 check, the swap wins by $24,000 in potential.
And here's the kicker. The new stock doesn't even have to hit its full target for the swap to win, does it?
Exactly. Run the break-even math on this. The new position, it only needs to go up about 23% of its upside to match leaving the original position alone. Anything above 23%, the swap comes out ahead. And even if the consensus price target turns out to be half wrong, meaning the new stock only went up 25% instead of 50%, you still come out ahead even after paying the IRS in full.
Listeners, honestly, that is the moment that most retirees physically cannot get past. They feel the $12,000 tax bill right now, today, in the present. They don't feel the $24,000 potential gain at all because it's in the future and it's only a maybe. But that's the trade they're making every single day that they refuse to run the swap. Certain pain now versus missing out on a much bigger potential gain later. That math is not even close.
And the only way to know which side of that trade you're on is to run the math on a real portfolio. And that's exactly what segment 2 does. The same kind of analysis applied to a real client's $410,000 account. But before we get there, Jerry, ground the listener on why our team's recommendations can be trusted. Full track record through December 31st of 2025.
Thanks for teeing it up. Here we go. Our one-year composite is up 36.3%. That was for 2025. The Dow Jones Industrial Average is up about 13% for the same period. 3-year average, 19.3% versus 13.2% for the Dow. 5-year average, 13.3% versus 9.4% for the Dow. 7-year average, 16.7% versus 10.1% for the Dow. Now, obviously, past performance, no guarantee for future results, blah, 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 blah.
Yeah.
Investment returns also will vary, though, based upon the investment objectives and the tolerance for risk for each of those.
You're right.
There are. But those numbers are posted on the organizedinvestor.com, our favorite website. We publish the last 4 digits of all those account numbers, those 198 accounts on there, just so you can actually see that these are legit accounts. Our clients can actually go and see their own information, should they want to.
And those numbers don't come from luck, listeners. They actually come from selectivity. Our team holds approximately 95 stocks at roughly 1% each. Jared and my dad manage every account in-house. No committee, no outsourcing. Dividend growth companies form the core, what we call the DSIP list. And when the market hands them an opportunity, the AI software sell-off right now would be one of those, or the Iran conflict trades, the COVID bargains in 2020, the tariff scare in 2025. Those are the opportunities they've been handed so far. They move quickly. That kind of move is impossible inside a fund where a committee meets monthly to talk about it.
Megan, that ties straight into the firm's 2% improvement goal that we talk about, the one every listener needs to memorize. Jerry, frame it up for us.
So here we go. Our team has, as Erik mentioned, a stated goal to try to improve everybody's overall return by at least 2% per year. And that's basically compared to, let's say, a comparable benchmark or, say, a prior advisor. Now, on a $1 million portfolio compounded over 20 years, that works out to roughly $485,000, folks. This is a lot of money off a 2% improvement. $500,000 from 2 percentage points, and it comes from 4 places.
4 places, listeners. Go ahead and write these down. Now, if you're driving, obviously don't write them down, but you can always come back and listen to us on theorganizedinvestor.com. Find this particular episode on the workshop page, and then you can write them down. So, number 1, lower fees. Our team's fee structure is meaningfully below typical advisory fees. That's on purpose. Number 2, lower costs by avoiding mutual funds. No expense ratios, no 12B1 fees, no internal trading costs, eating away at your returns. Number 3, less diversification with stocks. There's selectivity there. About 95 carefully chosen positions instead of thousands of indirect holdings inside funds. The industry calls broad over-diversification just diversification. We call it diversification.
Dun, dun, dun.
Because when you own everything, you own nothing. Your portfolio just becomes the index minus the fees. And number 4, more selectivity with stock selection. The DSIP list of dividend growth names as the core plus opportunistic buying during fear events. So lower fees, no mutual funds, focused holdings, and selective buys. That's the 2%. That's the $485,000.
So how do people get over-diversified? People end up over-diversified the same way they end up overweight, slowly, one snack at a time. The advisor adds a small cap fund, then an international fund, then emerging markets, then a value tilt, then a growth tilt, then a sector ETF. Before they know it, the client owns 11 different funds, collectively holding around 4,000 different stocks. On a Monday morning, the client's portfolio basically is the world market, minus 1% to 2% in fees compounding every single year. Selectivity is the opposite. You own 95 of the best companies that you can find, and when one stops being one of the best, you sell it.
Real quick, the workshop. I've grown to love these because this is the part of every show I personally make sure that everybody needs to hear, right? It's like, boom, 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 got to hear this. Once a month at Chesapeake's on Parkside Drive, Knoxville, Tennessee at 6 p.m. Dinner, adult beverages, a 60-page workbook you get to take home, all the questions you want to ask, a chance to win a signed football from me or some autographed pictures. You can register. It's free, and it takes 10 seconds to do. Go to theorganizedinvestor.com or call 865-415-2058. 415-2058. It's education first. No pressure. Tennessee Wealth Management. We don't run that high-end steakhouse. Here, we're trying to impress you and sign this right now. It's not that. It's a meal. It's a workbook. It's answering your questions. It's getting to know us, right? It's a small team doing big things.
Erik, can I plant a seed right now that we'll come back to in segment 2?
Go ahead, babe.
Listeners, tuck this away. Tennessee Wealth Management is offering to give you free estate planning documents for you and a spouse or significant other, a complete package, so durable power of attorney, healthcare power of attorney, advance directive, plus a will or revocable living trust for you or a couple valid in all 50 states. The entire commitment from you is a 5-minute phone call. You do not have to be a client of ours. You do not have to attend the workshop we do. You do not even have to come into the office. Megan will walk through the full mechanics in segment 2, but mark it now.
Yes, that is a perfect seed. All right, now let me bring us back to the tax tale with an analogy every listener understands. Think about the last time you traded in a car. Your trade, it took a hit on depreciation, maybe a few $1,000s you'll never see again. That hurt. But the new car runs reliably, gets better mileage, has the things you wanted in it. Every road trip, they all go better. The friction cost of the trade was real and smaller than the cost of standing still.
Erik, that is exactly it. So the tax on a portfolio swap is the depreciation hit on the trade-in. It's a real cost, but the price of getting into the better vehicle, right? So nobody refuses to ever buy a car again because the trade-in costs money, right? But that's the exact logic the tax-averse retiree uses on their portfolio.
And the feeling versus the number trap shows up everywhere else in life too. My grandfather used to do this with restaurants. He'd refuse to walk into anywhere that felt expensive, and then end up at a place where he ordered a steak that cost almost the same. He just felt like a smart shopper because the room looked less fancy. The tax feeling does the exact same thing. Meanwhile, on the other side of the ledger, you're losing way more than you saved.
Susan, that is the cleanest summary I've probably heard in 43 years. The tax-adverse investor is basically ordering that same steak in this worst restaurant because the room looks more humble, okay? He walks out feeling thrifty and poor by every measure that matters, actually.
All right, now let me put my football brain into this one. All right, here you go. Again, unless you're driving, close your eyes. When a quarterback gets sacked, ouch, right? The coach has to make a decision on the next play. Do you call something safe and punt, or do you go for it? Accept the risk of another sack because the upside is a touchdown. The tax tail investor is the coach who never goes for it, ever. Punts every single time because the risk of another sack, the tax bill, feels worse than the upside of a touchdown, and he can't figure out why his team isn't winning.
Erik, and the worst part, the lineup is wrong. Picture it this way. A .250 hitter is a stock you own that's just doing average, and you keep him in your starting lineup for 10 years because selling him would mean a tax bill. Meanwhile, a .350 hitter, a stock with way more upside, is available and you never make the trade for him. Multiply that across 5 positions, across 10 years, and the money you didn't make becomes a number you don't even want to look at. Opportunity cost is the most expensive line item in retirement, and it never shows up on a statement.
All right, Susan, before we head to break, every listener right now has a reason they haven't called another advisor to look at their portfolio. Give me the question I want them sitting with for the next 60 seconds.
Erik, I want to put the listener on the spot. Every week, somebody tells us why they haven't acted, and the excuses always come from the same place. Tax fear talking. Here are the ones we hear most. The taxes would be ugly. My broker says we should wait. It's a sentimental holding. I'll deal with it next year. Pick the one that you'd say right now and ask yourself, would you feel comfortable hearing it read by a stranger on the radio? If the answer is no, that's your tell. That's a feeling running your portfolio, not a number.
And remember, the umbrella for today's show, the most expensive sentence in retirement, quote, I don't want to sell, I'd have to pay taxes. Segment 1, we just showed you why that sentence is a feeling. It's not a number. Coming up, we're going to put a consensus price target to work here on a real $410,000 client portfolio, a real $30,000 tax bill, and a real $146,000 of potential gain on the right side of the trade. Plus the mutual fund advisory account problem and the full estate planning offer and the mechanics and all the phone numbers and all that stuff. This segment, we ran the math. Run it. It's not a feeling. Next segment, we run it on real holdings. Stick with us. It's the Organized Investor Show on News Talk 98.7, brought to you by Tennessee Wealth Management.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner, Trust and Will. Our next workshop is Tuesday, June 30th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.
Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Everybody calm down. We're back. I know you love the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, your host, Ainge. If you're just joining us today, today's show is called The Most Expensive Sentence in Retirement. And that sentence is, I don't want to sell because I'd have to pay taxes. Segment 1, we established that sentence is a feeling, not a number. Unless you die owning the stock or you give it to charity or it's inside a Roth IRA, the tax is coming either way. The only question is whether you pay for it on an upgrade or for nothing. This segment, we put real numbers on real positions and explain why most advisors physically cannot even have this conversation with you. Quick reintroductions. Megan Hubbard, Jerry's daughter, former teacher, Jerry Goodman, the man, the myth, the legend, CFP with over 43 years of experience in the business. My wife, Susan, the listener's advocate, we call her around here, asking questions you wish you could ask your own advisor. The framing of this next segment is simple. This is the math your advisor simply won't run. Jerry, set hut.
So here we go. All right. And now picture this. We have a long-term client that comes in with a taxable account. It's not an IRA, not a Roth. It's just a regular investment account that they've built up over time. Now, inside that account is roughly $410,000 spread over a handful of positions. Now, this is actually an actual client. Otherwise, I would have made this more simple with the math. So you know this is actually something that happened. And we do what every advisor should do. We go to the positions one at a time and ask one question. The question is, if we didn't already own this, would we buy it today at this price? Think about that for a second, okay? The answer on the whole $410,000 was no. I mean, upside on some of those names, based upon the consensus price target, was about 12%. We talked about that in the first segment, okay? So we are essentially just renting space with a portfolio like that when you have those types of stocks.
And to translate for the listener, 12% upside in this market on positions that aren't particularly dividend rich, that's a guy hitting 250 in the major league average. Not bad. But the bench guy, he's hitting 350. Why are you starting at the 250 hitter when the 350 hitters are sitting right there?
Exactly. So here's what we did. We sold the $410,000 worth of those 250 hitters. We swapped that money into 22 other stocks, roughly about, let's say, $19,000 each. Now, those stocks had an average upside of 55% versus the 12% that we got rid of. The math is really kind of staggering when you simply write it down.
Jerry, so before you get to the tax bill, give me the texture on the meeting itself. Who was in the room? How long did it take? Because most people imagine this kind of decision happens fast and off the cuff.
Susan, it was about a 90-minute meeting. We had 3 people in the room, including Jared, Megan, and myself. We pulled every position up on the screen, including the cost basis, the current price, dividend yield, consensus price target, at one position at a time, asking the same question: do we want to be in this same stock a year from now?
And for most of them, Jerry, the honest answer was no. Okay, now the tax bill question. You sold $410,000 worth of stock with embedded gains. The IRS is not going to send you a thank you card.
Susan, perfect setup. Tax bill on the swap was approximately $30,000, now paid right out of the sale proceeds. Now, here's the math that the average advisor is not going to do for you. Say $410,000 with a 12% upside is about $49,000 of expected gain. We redeployed $380,000, and at a 55% projected hopeful gain, that basically was an upside of $209,000 of potential gain, okay? So we paid $30,000 in tax up front. The expected gain went from $49,000 to $209,000, roughly, or $146,000 better off net of the tax. That's for one trade decision, folks, for one client.
$146,000. Yeah, I get why you're asking the questions. Yeah. Why would you do that if that's over there? Susan, the conversation most clients have with their current advisor about this, what does that sound like in your imagination?
It probably sounds like this. Hey, I've got $410,000 of stocks I'm not really sure about. What do you think? And the advisor says, well, you've got embedded gains. The taxes would be ugly. Let's just hold them. End of conversation. The client walks out having lost $146,000 of expected gain, and the advisor, he congratulates himself on being tax efficient.
Susan, that is exactly how it goes, okay? Word for word. My dad has had clients quote that conversation, honestly, back to him from their prior advisor, almost verbatim. The most expensive sentence in retirement said by somebody being paid to know better. And listeners, this is the moment I want you to lean in. Most advisors took the Series 65, the Series 7, the Series 66. Those are security exams, not tax exams. So when a client asks a tax question, the advisor has 2 options. Option A, admit, I don't actually know, you'll have to ask your accountant. Or option B, use vague phrases like the taxes would be ugly to avoid the question entirely. Most pick option B because option A, well, it just sounds bad.
B sucks too.
Well, so this is where we get to brag for a moment because at Tennessee Wealth Management, our little office, we're built a little differently. My son-in-law, Jared Hubbard, who happens to be Megan's husband, Jared is a CPA as well as being an advisor on our firm. So most firms have an advisor who hands tax questions off to your accountant somewhere else. We have a CPA in the office. And when a client asks a tax question, guess who gets to answer that question?
And I can promise you he actually does have the qualifications and did take the CPA exam, unlike a lot of these advisors who just have these other exams we mentioned, because I remember really kind of being a single wife there for a while.
When he was studying?
All he did was study and then worry, am I going to pass this part of the test? So, oh boy.
Well, I'm sure you were a great single mom, Megan, even though you weren't, but you were because Jared had to do it. Jared is the accountant, qualified by license, not by guesswork. He's our stud.
And Jared spends much of his week running cash flow analysis and tax projections. I mean, goodness, does it get any more exciting than that?
Ooh.
He can build what we call a tax map, when to pull money from where, when to do a Roth conversion, when to harvest gains, and when to harvest tax losses. Most clients have never had anyone in their life look at their full picture like that.
Jerry, can I ask the question I think most listeners are sitting with right now? If their advisor doesn't have a CPA next to them and can't run real tax math, what are they actually paying for? Because most advisors charge an advisory fee on top of whatever fund expenses are already there. So what's the listener getting for that money?
Susan, you just teed up what I think is the most under-discussed ripoff in modern retirement advice. It's called the mutual fund advisory account. Jerry, walk us through it, because most listeners have never heard the term, even though they might be experiencing it.
We see it all the time, and it works like this. You walk into a big name brokerage firm. They open up what we're going to refer to as a mutual fund advisory account, as Erik just mentioned. You're going to pay them an advisory fee that could be, let's say, from 1 to 1.5% based on however they feel that day for that advice. And then the portfolio they build for you is basically filled up with a lot of mutual funds.
And listeners, hear me on the fee layers, okay? The mutual funds inside that advisory account already charge their own expense ratios, typically another 0.5% to 1% per year. That's not a small amount. Then there are 12B1 marketing fees buried in the prospectus that nobody reads, plus internal trading costs nobody bothers to calculate. 2 layers of fee minimums, usually 3. That fee stack compounds against you every single year, whether the funds make money or lose it.
And Jerry, the December surprise, the capital gains piece, that's the same mutual fund advisory account problem, right?
Same problem, Susan. Those same funds, they hit the clients with capital gain distributions around the end of the year, usually in December, for trades the fund manager made on stocks that the client personally never chose themselves, okay? You're basically paying someone to advise you to be a passenger in your own portfolio. That's not advice. It's a subscription. And we're going to spend some time on the December surprise in the next segment, number 3.
Quick huddle up here, quick break for the workshop, because if there's any show this year where the workshop conversation matters, it's this one. It's Chesapeake's on Parkside Drive right here in Knoxville, 6 p.m. once a month. It's dinner. It's a great meal. Adult beverages, if you are so inclined, and the 60-page workbook that you get with so much information from us at Tennessee Wealth Management. Chance to get an autographed football or some pictures. And you can sign up. It's free and it's easy. TheOrganizedInvestor.com is where you do that, or you call 865-415-2058, 415-2058. The Jared corner of the workshop is where most of the tax questions land. Now, he's there every time. It's education first, no pressure. Tennessee Wealth Management. We don't run the high-end steakhouse experience. We're not trying to impress you. We're trying to get to know you. Say hi. Maybe this will work, and maybe it won't. All right, Megan, listeners heard Susan plant the estate planning seed in segment 1, and here's where it ties to our umbrella today. Quote, I don't want to sell. I'd have to pay taxes. The most expensive sentence in retirement. Right next to it is, I'll get my estate plan later. I'll do that another time. Both are tax fear and time avoidance wearing different costumes. So, Megan, what's the full offer?
I'm taking this one because I want listeners to hear it from somebody other than my dad for once, okay? So we have an unlimited annual subscription with our online partner, Trust and Will. We provide a complete set of estate planning documents to listeners, completely free of charge with no cost and no obligation. The package has a durable power of attorney, a healthcare power of attorney, an advanced healthcare directive, and either a will or a revocable living trust. Covers you and your spouse or significant other, and it's valid in all 50 states. About 95% of listeners are good fits for the online Trust and Will package. The other 5% with more complicated situations get introduced to a flat fee attorney that we know here locally.
And here's the statistic that I want everybody to understand. 75% of you listening right now either have done nothing, no estate plan, no documents, nothing, or what you have done is out of date. 3 out of 4 of you. Basically, you're almost certainly in that bucket, just from a percentage standpoint. And here's the part that really drives most people crazy. We don't make a dime off this, okay? This seems to bother people. But 25 years of helping people with estate planning, we never received any compensation related to estate planning, not once, not in 25 years. And some will say, well, nobody works for free. Well, we're sorry, folks. We really don't charge anything for this. We're just trying to do a good deed on occasion.
Jerry, walk listeners through the mechanics, because I think this is where most people freeze. They hear free and they think, well, what's the catch?
Susan, absolutely no catch. Call me directly at 865-415-2070. Again, that's 865-415-2070. It's like a 5-minute brief little phone call. And assuming that you're in that 95% group that has a simple situation, we're going to email you a link. Now, at that point, you can do this completely on your own. We'll give you a little bit of help if you need it. You can come to our office and we'll help you from start to finish in one trip and walk out with the documents completely free of charge, okay? You don't even have to be a client. You don't even have to come to the office if you don't want to.
And to be very clear, this is the part where people get confused. You do not need to attend the workshop. You don't need to come into the office, and you don't even really need to be a client. This entire commitment is a 5-minute phone call. This is the single kindest thing you can do for the people you love the most. Retail value at Trust and Will would be about $500, several thousand if you went through a local attorney. The cost to you is $0 if you take us up on this offer.
And one more line, because we plant this seed every single show and it deserves repeating. The day you need it, you can't get it. If you have a stroke tomorrow morning, you cannot sign a healthcare directive tomorrow afternoon. If you pass away unexpectedly, your family cannot draft a will at the funeral. Estate planning is the one financial decision that has a hard deadline you don't get to see in advance. So please, pick up the phone, 865-415-2070.
Football analogy time on estate planning, because this one writes itself. Bad coaches get out-prepared every Saturday and Sunday. The week leading up to the game, it's when you study film. You're scouting the opponent, looking at tendencies, looking at your own self-scout. What do we do? What do they do? You're rehearsing the calls. You're going through the practice, getting the motions. You don't do game prep on game day. You're prepared or you're not before kickoff. If you didn't do it, tough. You're not going to have a good football game. In estate planning, the other team is chaos, probate, family conflict, and Uncle Sam helping himself to whatever you didn't bother to allocate.
So let's go back to the swap we were talking about a little earlier, because I want listeners to leave this segment with an actual takeaway. We had a $410,000 position that had about a 12% upside on that. We sold that. $30,000 in taxes were paid off the proceeds. We assumed that a 20% capital gain rate, which it could have been less than that, but we're going to try to be conservative. So we had $380,000 after tax we reinvested. We assumed they were going to go back in 22 stocks, and we were assuming they had a potential upside of 55%. We can't guarantee that's going to happen, obviously, but that was the assumption. So basically, net advantage in that whole projection was $146,000 of gain, okay? Because we went from something with a 12% upside to something with 55% potential upside, even though we had to pay some taxes along the way.
Well, and when you're a client, you're not doing the work. Hey, Jerry and Jared and everybody, they're doing it for you. So imagine your prior advisor said, well, the taxes would be ugly. And the client said, oh, I'll stay put. Okay, well, that's $146,000 of expected gain gone. And again, you don't have to do it. Tennessee Wealth Management does it for you. All right, Megan, let's tie this back to our 2% callback.
All right, so remember that 2% improvement goal. It was the $485,000 of additional value over 20 years on $1 million portfolio. That comes from 4 places, right? The lower fees, avoiding mutual funds and their layered costs, less diversification with stocks at about 95 names, and more selectivity in stock selection, the DSIP list, plus opportunistic buys during fear events. The swap we just walked through is a textbook example of source number 4, selectivity.
Short track record reminder, because we want anyone tuning in mid-show to have the numbers in front of them. 1 year, our average return for 198 accounts was 36.3 versus 13% for the Dow. 7-year average, 16.7% versus 10.1% for the Dow. Past performance is no guarantee of future results. Returns vary by account.
And the AI software sell-off right now. Same selectivity logic in real time. Microsoft, Oracle, Adobe, DocuSign, CoreWeave, ServiceNow. names beaten down in recent weeks. And the consensus price targets imply average upside over 50% on the basket our team has been adding to. They are not on the sidelines watching. They are buying, funding those purchases by selling positions that weren't doing much. That's the swap in action. Impossible inside a mutual fund.
Iran conflict. Quick hit, Jerry. Travel down, oil up. Same playbook?
Same playbook, Susan. You're going to sell things that no longer are giving you some upside and buying the names that the market has basically put on sale or buying them down at a low level. A mutual fund manager can't do that mid-month. A committee is going to have to go through an entire process just to get some idea about what they're going to do, okay? That's why the track record looks the way it looks for us versus a lot of other things in the market.
And it's impressive. All right, Mrs. Ainge, let's talk about why the listener may not do any of the things that we're talking about right now. You compare everything else. What are listeners waiting for when it comes to this?
Erik, that's the whole question right there. You compare everything else. You compare grocery prices. You compare gas stations. You compare cell phone plans. You compare the dealership down the street to the dealership across town. You compare everything.
When was the last time you compared what your advisor actually delivers to anything else? Performance, fees, tax planning. Have you compared any of these? If you've never compared, then you've never decided. You've just defaulted. And defaulting is exactly how somebody ends up paying 2 layers of fees on a mutual fund advisory account they never inspected.
And here's the kicker. Most listeners couldn't tell you what their advisor charged them last year if you asked. Not approximately. Actually, in dollars. They don't know. They don't ask because asking feels rude. But asking is not rude. Asking is the floor of being a competent adult with your own money.
All right, on your mark, ready, set, go. That's the segment. All right, you got to bring us your statements. Tennessee Wealth Management will run the math that your current advisor won't. Show you what your real fees are, what your real tax exposure is, and whether doing some swaps might help with things that you've been sitting on for years, untouched. Coming up in segment 3, what happens to mutual fund investors every December when the tax bill arrives for trades they didn't make on stocks they never picked? Plus, the Roth conversion window. And the closing question for the whole show, are you driving or are you in the back seat? It's the Organized Investor Show brought to you by Tennessee Wealth Management, wrapping it up next.
Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Are you a passenger or are you a driver? Welcome back to the Organized Investor Show brought to you by Tennessee Wealth Management. Final segment of today's show, quote, the most expensive sentence in retirement. That sentence is, I don't want to sell, I'd have to pay taxes. And we've spent the last hour-ish going on it, proving why letting that sentence drive your portfolio costs more money than any other investing mistake that we see here at the firm. Segment 1 was the philosophy. Ugly is a feeling, not a number, which refers to the advisor who says, well, taxes will be ugly because he doesn't want to do the math. Segment 2 was the math. A real client, $410,000 account, swapped it, $30,000 in tax, ends up bing, bang, boom, with $146,000 of expected gain on the right side of the trade. This segment's about you. Application, and the framing is simple. Are you driving your portfolio, or are you in the backseat while somebody else picks the stops, hits the brakes, hands you the speeding tickets? How about that? With me, as always, Megan Hubbard, former first grade teacher turned advisor, Jerry Goodman, CFP for over 43 years, my wife, Susan, and she's your advocate, asking the questions you'd ask yourself if you were here doing this with us. Mrs. Ainge, would you open this one for us? Because what you walked into with your parents is exactly the right place to start.
Okay, I'm opening it with something that happened to my father. December rolls around. My dad opens a tax document from the mutual fund company, a capital gains distribution. Several $1,000s in taxable income just dropped on him like a Christmas card from the IRS. He didn't sell anything. He just owned the mutual fund, and the fund manager, somebody he has never met, made trades inside the fund. Those trades created capital gains. The fund is required by law to pass those gains through to him. He owes the tax on stocks he never personally bought that somebody he has never met sold. Erik, what is that?
Yes, Susan, that's the textbook definition of being a passenger in your own portfolio. The mutual fund holder doesn't drive. They sit in the back seat while somebody else picks the route and hits the brakes for them. And when the cops pull the car over, guess who gets the ticket? You. Because the IRS doesn't care who chooses the trade, only the gain that happened in your name.
And the part that compounds that insult is those distributions can hit even when the fund actually lost money for the year. Your fund could be down 4%, and you still get a capital gain distribution at the end of the year. Because the fund manager sold some winners early to cover, say, some redemptions, those gains pass down to you, even though the overall return of the fund was negative. It happens every year to somebody out there.
Listeners, if Susan's parents had owned the same stocks individually, not wrapped inside a fund, they would have had control. They could have decided when to sell, offset gains with losses elsewhere, and timed gains to a low income year. None of that exists inside the mutual fund. The fund makes the call, you get the bill. That's the difference between owning stocks and renting fund shares.
And here we go, because Jerry, the contrast at Tennessee Wealth Management on individual stock management.
So, Eric, at the moment, we have about 95 stocks with roughly 1% in each one, okay? Every trade is a decision that Jared or I make deliberately with the client in mind, okay? Not with redemptions from 80,000 other fund shareholders in mind. We don't do that, okay? We choose when to take gains, when to defer them, and when to harvest a loss to offset a gain elsewhere. That is tax loss harvesting that fits your situation, not the average client, not the median holder.
That brings us to the Roth conversion window. We've been talking about this. Jerry, this might be the single biggest piece of money on the table in most listeners' financial lives that no one is helping them grab. It's right there. Take it.
That's exactly right, Eric. So here's the setup. When you retire, your earned income usually going to fall off a cliff. It may drop from, say, 32% federal bracket down to, let's say, maybe 12% overnight. So for a few years, you're standing in one of the lowest tax brackets of your adult life. Then what happens at age 73? Then you hit those years where you have what's called RMD, required minimum distributions, which kick in from your traditional IRA. That's money that gets added to your income, and it gets pushed right back down. Then at the age of 73, what happens? Required minimum distributions kick your traditional IRA, that money that gets added to your income, it pushes you into a higher tax bracket once again, possibly the highest forever.
So what's the move? In those years between when you retire and when RMDs hit, you convert traditional IRA dollars into Roth IRA dollars at the lower bracket. So a $100,000 conversion at 12% costs $12,000. A $100,000 conversion at 22% costs $22,000. Most people have multiple chunks to move. Multiply that over 8 to 10 years, and you're talking real money, sometimes hundreds of thousands in a lifetime tax savings.
Doing this and not doing this really is not an option. Jerry, so we keep talking about the window, the Roth conversion window. Explain why that's time sensitive.
Well, the Roth conversion window actually is a window, okay? And windows can open, but they can also close. Every year you don't use it, the window, it gets smaller and smaller. So by age 73, that window is mostly shut. RMDs are now in the picture. The math gets uglier, and you're handing the IRA basically years of compounded tax-free growth that should have been growing inside of a Roth that, it would have helped both you and your kids.
Yeah, after learning this, I can't fathom why people would not do this. It just doesn't make sense. And this is exactly the kind of conversion that a normal advisor cannot have because they're not qualified to model it. And at Tennessee Wealth Management, Jared can.
Jerry, can I get a real world example? Because the math is starting to feel abstract. Couple in their early 60s, what does the window actually look like for them?
Perfect. Couple, both 63, both retired, $800,000 in a traditional IRA, $200,000 in a Roth, $300,000 just in a taxable brokerage account, and they'll start taking Social Security at 67. So right now, their household income is essentially zero, except maybe for dividends or some part-time consulting they might be doing. They're sitting at a 12% federal bracket for the first time in their adult life. So for 11 years, from 62 to 73, they have a chance to convert these chunks of these traditional IRAs into a Roth at a 12% rate instead of getting forced into RMD distributions, required distributions at 22% and higher.
Let me run the numbers because this is the part listeners need to hear out loud. Move $60,000 a year for 11 years. That's $660,000 converted out of the traditional IRA at the 12% bracket. Tax on those conversions is about $79,000 total and paid out of the taxable brokerage account, so the Roth itself actually stays intact and keeps growing. If they had done nothing and let RMDs at 22% force the income later, the tax on that same $660,000 would have been roughly $145,000. That's $66,000 in lifetime tax savings on the conversion side alone. Plus, all the growth on those converted dollars happens tax-free forever, including for their kids.
Jerry, $66,000 in lifetime tax savings on the conversion math alone, and that's not even the bigger number. The tax-free growth is the bigger number, right?
Susan, exactly. That $660,000 in Roth dollars, compounding tax-free for the rest of their lives and then for their kids' lives, that's generational money. A real Roth conversion plan run over the right window is worth more in lifetime value than the entire taxable account that holds the rest of the money.
Quick huddle up, quick break for the workshop, because this is the show where the workshop conversation, it matters most, guys. It's at Chesapeake's Parkside Drive, 6 p.m., right there in Knoxville, once a month. You get dinner, adult beverages, if you'd like. You get to hang out with us. You get a 60-page workbook, signed football from me. We give it out to one lucky person there at the workshop. When we talk about all this stuff, this is the Jared corner of the workshop. Jared Hubbard, again, that's Megan's husband. And this is where most of the tax questions land, and he's there every time. You can sign up. Again, it's free RSVP on the website, theorganizedinvestor.com, or call 865-415-2058, 415-2058. There's no annuity pitch, no long-term lockup, no high-end steakhouse experience. It's educational, period. You get to come meet our small team and see the big things that we're doing. All right, Mrs. Ainge, this is your moment. The estate planning offer to reinforce for the listener.
All right, listeners, quick reminder, because somebody tuned in late, that free estate planning package, durable power of attorney, healthcare power of attorney, advanced directive, will, or revocable living trust, you and your spouse, all 50 states, that's sitting there waiting for you. It is genuinely free. It is genuinely a 5-minute phone call. You do not need to be a client. You don't need to attend the workshop we do. You don't even have to come into our office. And on Eric's behalf, I want to ask you the question. What happens if you wait? Best case, nothing. Worst case, your spouse pays for it. The chair you're sitting in right now is the chair where this gets decided. So pick up the phone, 865-415-2070. That rings directly to Jerry's cell.
And to put a bow on what Susan just said, if you're waiting for this to get any cheaper, folks, it physically cannot. Free, as they say, is the floor. It can't get any lower than that unless maybe we pay you for it, and we're not apt to start doing that.
I want to come back to something Susan said about her dad earlier because it ties into the umbrella theme. The I don't want to sell investor and the I owned a mutual fund and got a surprise tax bill investor are the same person. Both have given up control, one to a feeling, one to a fund manager they've never met. Either way, somebody else is making the tax decisions on their portfolio. And either way, the investor is in the back seat wondering how they got there.
All right, and Megan, that's exactly the thread. The most expensive sentence in retirement is, I don't want to sell, I'd have to pay taxes. Because the second you say it, somebody else is making the decisions for you. Could be a tax feeling, an advisor who can't run the numbers, a mutual fund manager that you've never met, or the IRS at 73 dragging you out of a traditional IRA at the worst possible tax bracket. The common factor, it's not you, that's the problem. That's what Tennessee Wealth Management is trying to change for you.
And to translate that for a normal household, taking the wheel doesn't mean you have to know everything yourself. It means you have somebody at the table who does. Somebody who can answer the tax question in the room, not ask your accountant. Somebody who can model the swap, not that taxes would be ugly. Somebody who can see the Roth window before it closes, not after. That's what driving looks like.
No, yes, that's exactly right. The football version of passenger versus driver. Imagine sitting on the bench and every Sunday somebody tells you, we lost on a screen pass to the running back. And you say, wait, I didn't call a screen pass. And they say, we know, the coach did. You weren't really a part of the decision. That's the mutual fund investor every December. Somebody else called the play, you got the loss on your record, and you weren't even on the field. At Tennessee Wealth Management, the listener is the coach. They've hired Jerry and Jared as their offensive coordinators. Megan, give the football frame on the Roth conversion window. You got this.
The Roth conversion window is the 2-minute drill of retirement planning.
Clock's ticking.
There is a clock, and it is running. Every play you waste is a play you cannot get back. The years from when you retire to when RMDs hit, Those are the highest value tax planning years of your life. A normal advisor watches them pass. A real tax-aware team uses them.
And listeners, please understand, this is not a story Tennessee Wealth Management tells about themselves. This is a story their clients tell on the verification page on the website with the last 4 digits of their accounts attached. That 146,000 on the 410,000 swap, the 12,500 trades in a single day during the tariff scare, 36.3% in 2025. Verifiable, posted, public.
Let's give a quick performance reminder because you want anyone who joined us late to have the numbers in front of them, or at least in front of your ears. 1 year, our average return was 36.3% for 2025 versus 13% for the Dow. Our 7-year average, 16.7% versus 10.1% for the Dow. Again, past performance doesn't guarantee future results. Returns can also vary based upon investment objectives and risk tolerance for each client.
Sure they can, but 36.3%, I bet all the clients, I know everyone I've met is happy, but just for last year alone, yikes.
Happy campers.
All right, and that 2% callback one more time because the whole show is, well, it's based on 2%.
The 2% improvement goal, roughly, it equates out to $485,000 in additional wealth if you compound a $1 million portfolio over a 20-year period. That's where that comes from. And that is possible from 4 places, okay? Lower fees, avoiding mutual funds, less diversification with stocks instead of having a bunch of mutual funds. And the DSIP list basically gives us opportunity to be much more selective when we have some buying opportunities. So today's entire show is about one thing, though, about selectivity and the swap and those Roth conversions.
And selectivity is the source that compounds the hardest, okay? Once you've sold a 250 hitter and replaced it with a 350 hitter, the gap doesn't show up in 1 year. It shows up over 5 and 10 years. Same with skipping the Roth window. You don't feel it in the year you skipped it. You feel it at 73 when the RMD bill arrives. That's how this stuff hurts, slowly, quietly.
Erik, can I drop one more reminder before we close? Listeners, you don't have to do everything at once. You can call about estate planning and never talk about your portfolio. You can come to the workshop and never call again. And none of those doors, none, cost you anything to walk through.
You can't afford not to do it. That's our show. The most expensive sentence in retirement is, I don't want to sell, I'd have to pay taxes. That's a feeling. It's not a number. It is the answer your advisor gives you when they don't want to run the math or when they aren't qualified to. The fix is the same in every segment that we did today. Take the wheel. Stop being a passenger in your own portfolio. Bring your statements to us at Tennessee Wealth Management. Let us show you the swap your old advisor wouldn't run. Let us show you the Roth window before it closes. And let us give you the free estate planning package while we're at it, while you're there with us. 3 different doors, all 3 open. Go to our website, please, theorganizedinvestor.com. Call 865-415-2058 for the office and for the workshop. If you want to call Jerry and bug him, I do it a couple times a day. 865-415-2070. That goes directly to Jerry's cell. You can get that estate planning offer, talk to him, and, we'll figure this out, guys. It's all good. Again, it's me, Erik Ainge. You've been listening to the Organized Investor Show on News Talk 98.7, brought to you by us, the GOATs, Tennessee Wealth Management. We'll see you next week.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of the Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes.